Thanks for joining us at XM.com. This is The Week Ahead. I'm Cristina Marujos. With me today is our senior investment analyst, Haralambos Pissouros. Haralambos, let's start with the United States. Non-farm payrolls are out on Friday. Arguably, the labor market in the U.S. remains quite resilient. So what could we see in the data, and what could that potentially mean for the dollar?
Hello, Cristina. Yes, the US labor market remains resilient, but we have seen signs of softness lately. Remember that the October report disappointed, resulting in a sharp decline in the US dollar. Then it was the cooler than expected CPIs for the month that hurt the greenback, with the latest strong hit coming from Fed Governor Waller earlier this week. Waller said that if the decline in inflation continues for several more months, they could start lowering the policy rate. This was the first time a Fed official discussed the possibility of a rate cut, and that's why market participants added to their rate cut bets, with a 25 basis points rate cut now being fully priced in for May, and the full number of basis points worth of rate reductions expected for next year, increasing from 90 to around 115. Now, with regards to Friday's jobs report, the unemployment rate is expected to have held steady at 3.9%, and non-farm payrolls to have increased to 175K from 150K in October. Now, such numbers are unlikely to shake much expectations with regards to the Fed's future course of action. And in my opinion, for that to happen, wage growth may need to accelerate as well. Why this could spark some fear that inflation could pick up steam in the months to come, thereby prompting the Fed to keep interest rates high for longer than currently anticipated. Now, on the other hand, further slowdown in wages could solidify investors' belief and push the dollar even lower. After all, lately market moves suggest that investors are selling the dollar more aggressively when data or headlines corroborate their view, compared to buying it when there are indications supporting the higher for longer case.
Haralambos, now let's turn to the central bank front. The Reserve Bank of Australia is expected to keep policy unchanged this week's meeting. So how could we see the Aussie perform?
Now, I believe that the Aussie could still gain even if the RBA remains on hold, and I will explain why just now. The minutes of the previous meeting revealed concerns about high inflation, and Governor Bullock has been sounding hawkish in her recent speeches, allowing investors to keep rate hike bets on the table. Even after the monthly year-over-year CPI rate for October dropped by more than expected on Wednesday, investors continue to assign a decent 40% probability for another hike by March. Perhaps that's because the closely watched trimmed mean CPI only ticked down to 5.3% from 5.4%, which is still well above the RBA's target range of 2 to 3%. And because the monthly CPI data does not show all the components included in the quarterly CPI. Now, what's more, the wage price index for the third quarter rose to 4% from 3.6%, which implies upside risks to inflation in the months to come. So, with all that in mind, the RBA is unlikely to clearly signal that this hiking cycle is over. Officials are likely to maintain the view that interest rates could further rise if needed, which could allow the Aussie to extend its recovery against the US dollar. That said, the Aussie may not be driven only by the RBA decision next week, as on Wednesday, Australia's GDP for the third quarter is scheduled to be released, while on Thursday, Australian and Chinese trade numbers are coming out.
And finally, Haralambos, crossing into Canada, the softer economic data might signal the end of the tightening cycle for the Bank of Canada. Is it too early, though, for policymakers to discuss rate cuts when they meet on Wednesday?
Yes, it is. And I will explain why. when they last met, policymakers of the Bank of Canada held rates steady, moderating spending and relieving price pressures, but they remained prepared to raise the policy rate further if needed. Since then, data have been coming on the soft side, with inflation cooling more than expected and the economy contracting in the third quarter, which has led investors to price in around 105 basis points worth of rate cuts by the end of 2024. Confirming so many basis points worth of cuts after signaling that you are prepared to do more seems an unwise choice in my opinion. I believe that they will avoid discussing cuts at this gathering, but a strong hint that interest rates have peaked may still weigh on the loonie. And I am saying that they could signal the end of this tightening crusade because just last week, Governor Macklem said that interest rates may be at their peak given that excess demand has vanished and weak growth is expected to persist for months.
Haralambos, thanks so much. This was a week ahead here at xm.com.